A very good evening to all our guests. Welcome to IIFL's second webinar today covering the budget 2025. In the first webinar, we earlier in the day focused on economic and market impact of the budget announcements. In this one, we will specifically focus on the tax proposals announced and the impact on business and consumers. Now, for that, we have with us our distinguished guest from Dhruva Advisors. Dhruva is our tax partner and has been recognized as Tier 1 tax firm in India. Their 5-year consecutive recognition as India Tax Firm of the Year at International Tax Review Awards has also made history. They have a strong track record of designing and implementing pioneer solutions in several areas of domestic and international taxation. From Dhruva, we have the pleasure of having Mr. Umesh Gala today. He's a fellow member of Institute of Chartered Accountants of India and has 30 years of consulting experience in direct tax, transaction structuring, tax advisory, litigation services, and regulatory matters. We also have Vishal Lohia joining us. He's also a chartered accountant with over 10 years of experience in the tax and regulatory matters, with special focus on financial services. So this team will help us decode the budget tax proposals for your benefit. We will have them run us through their presentation first, and then we can jump on to the Q&A session. For asking questions, please type in your questions in the Q&A window, which is appearing at the bottom of your screens. At any point of time, if you want to type in a question, that question will come to us and we will take it up in the Q&A round. So let's hear from Umesh first on what his views and thoughts are on the budget proposals.
Yeah, thanks, Gaurav, and very good evening to all of the participants. Before I deal with the direct tax proposal, just maybe as a warm-up, if you look at the entire background, the background through which this budget has been presented, I think there's been a global growth slowdown, two wars of which there is a ceasefire on one, but there is a tariff and trade war which is looming right in front of us. If you see our domestic setup, I think India continues to remain the fastest growing major global economy. Q2 growth did slow down, and I think there was a little bit of pressure for this government to bring back the growth back to the expected level. We had elections last year, and I think the BJP underperformed, and possibly if you see how the middle class seems to have been rewarded, possibly the middle class has done their bit by pressing the button on the in the elections. And I think this is an important perspective that we have to keep in mind. Vishal, can we move to the slide? So I think, for the first time in so many years, when we see the budget speech, I think there is a clear mention about, four aspects that the government wants to look at. And, they are clearly identifying reforms as a fuel for bringing India back to the Viksit Bharat agenda. And when they have identified 6 sectors, of the 6 sectors, taxation is a major sector, and therefore there is a very strong commitment by this government to bring tax reforms, sizable tax reforms, to ensure that the ease of doing business. As professional advisors, we've always held this belief that the way the Indian tax regulations are, and more so the way they are administered, leaves a lot of gap in terms of how international investors would look at a destination like India, with all the positives that are there in play in India. So there is a proposal to introduce a new income tax bill, which will definitely go through the whole process in terms of the bill being referred to a select committee, and there'll be a consultative process. And post the consultative process, one hopes that before the next budget is presented, we'll have a new income tax bill, which will income tax law, which will meet with the aspirations of India, which is looking at becoming a developed nation by 2047. Uh, since you've already had economic presentation, I wouldn't want to deal with much on the general economic aspects of the budget. But when we look at this year's budget, there are, I mean, the budget is uh, concise partly because the government doesn't want to do a lot of tinkering because there is an income tax bill which is likely to come, and therefore barring the major slab rate changes and a few provisions uh, to reduce the compliance burden, to rationalize the TDS, TCS provisions, encouraging voluntary compliance, and some of these aspects Vishal will take you. I think the budget provisions are reasonably concise. Also on the indirect tax, to give a flavor of what we are expecting as a nation, how would we respond to the looming tariff war, and therefore there is a rationalization of the customs tariff. 15 customs heads being narrowed down to 7, a lot of reductions as well. On the regulations that impact foreign investment, I think, and the general business environment, I think two, three things which are worth mentioning. One is the FDI limit on the insurance sector, which is currently at 74%, now goes to 100%. But more importantly, and this is possibly the first time that this limit is being raised to 100% only for companies which invest the entire premium in India. So while the government wants to encourage foreign insurance companies with 100% equity ownership to set up shop in India, but this is with a rider, and therefore the money which the Indian insurance policy holders pay should remain invested in India, and which will be good for pumping up the growth in the overall economy. Uh, as a firm, we are party to a lot of deliberations that are happening in the North Block in terms of bringing out a tax bill which is forward looking, and there is a mention of a high level committee on regulatory reform. So as I said, that 6 sectors have been identified, and one hopes that the high level regulatory reforms committee will do the job. Already, even before the budget has been presented, there's a separate committee in the Niti Aayog, which is so multiple parts of the government are trying to keep their eye in terms of how the reforms can really be engineered to make India a good investment destination. Something which is worth mentioning is that they have clearly identified that company mergers, uh, a process to give speedy approvals, including fast track mergers. So widening the scope of fast track mergers, which is currently available to subsidiaries, that is also likely to be put in place. When we discuss, and maybe Vishal, you can go to the next slide. When we discuss the tax proposals, again, 3, 4 important points. In the last 10 years of this government, which is 2014 till 2024, the overall tax collections have grown almost 3 times. The tax buoyancy is very high. So whatever is the nominal GDP growth, the tax collections have been a little notch above the nominal GDP growth of the nation, and therefore this is possibly one of the factors which has influenced. When we see the budget, there are no negative uh, provisions or nothing major in terms of negatives, no tinkering. Uh, in terms of expectations, there are no surprises, and therefore market always like no negative surprises. So some positive things on how the budget has come. A few misses that possibly I would want to deal with is that there was an expectation that the concessional regime for manufacturing companies, which is at 15%, would again be brought back, and this was a very strong expectation, but that's not seen the light of the day. While in the budget, there are provisions to rationalize the TDS, TCS provisions. But again, here, what the industry and advisors, the way we were gunning for a reduction in number of TDS rates to ensure that people don't struggle with interpretation. I think that has not seen major miss in terms of dispute resolution. So any tax dispute almost takes 20 years before you have a final verdict from the Supreme Court. Already at the Commissioner Appeal, there is a backlog of 5-6 years. So nothing major has been incorporated in the budget to reduce the time frame for disputes and also reduce the overall dispute. Before we come to the major provision, which has possibly caught the fancy of the entire middle class or entire tax-paying public, just a small point on this self-occupied property. So in India, there is a regime for income from house property. And if you have a self-occupied property, earlier it used to be exemption for one self-occupied property. And that exemption was extended to two properties. But for the second property, either it had to be self-occupied or you had to demonstrate that you couldn't occupy the house property for reasons of business or employment, and therefore, if you are unable to stay because you are posted somewhere out of location, then you were entitled to a exemption, and deemed let out income for such house property was not added to your income. I think what the government has done in this budget is to remove the requirement to have a condition. So irrespective of for any reason, if you have two house properties, then there is an exemption from deemed let out income on such house property, which is a welcome change. Uh, on the slab rates, clearly last few years the direction is very clear that there is an existing regime for personal tax where the slab rates are much shorter, the tax rates are higher, but you get the benefit of any deduction and exemption. Parallelly, the government clearly seems to be hinting that we want the overall tax regime to be very simple, easy to comply, and therefore we will eliminate a number of exemptions and deductions. So the new tax regime is where the nudge from the government is, and every year over the last few years we are seeing that they are making the new regime far more attractive. If you see the overall surcharge, the highest surcharge is lower for people in the new tax regime. If you see the number of slabs uh, for the new tax regime, in the old regime, the 30% tax rate kicks in at 10 lakh, whereas what we had before the budget, it was 15 lakhs, and that has now been increased to 24 lakhs. So clearly, the arbitrage that is available for any taxpayer in terms of when he is deciding whether to go in for the existing old regime or new regime, I think the arbitrage is being made more in favor of people to opt for the new regime. If you see the newspapers, there's a little bit of confusion in terms of how this rebate will actually benefit. So clearly what is being talked about is that any income up to 12 lakh rupees, taxpayers will pay nil tax. And the way this accrues to the taxpayers is that you calculate the tax liability as per the new slab, which is there on the right-hand side of the slide. If you see, each of the slabs have been expanded. Instead of 6 slabs, now you have 7 slab. You calculate your tax liability as per this slabs. Now, if your overall taxable income is 12 lakhs, then whatever is your tax liability comes to you as a rebate. And this is a rebate under Section 87A, and therefore your tax liability effectively gets converted to nil income. Now, because this is structured as a rebate, you still have to file your tax return. Couple of clarifications that this does not, I mean, you don't get a rebate in respect of your capital gains tax, especially if there is concessional tax under long term or short term. A lot of people possibly misconstrue, and I think we will present this in the next slide, that this is not a benefit just for the middle class. If we actually see the way, because the slab rates have been extended, this is a benefit that is available to all taxpayers, irrespective of whether you are in the lower income bracket or you are in the higher income bracket. The only difference is that people who are in the lower income bracket, proportionate to what the tax liability they were paying earlier, they are getting a sizable benefit. And if you see from a macroeconomic perspective, in the last 3-4 years post-COVID, the government has done all the heavy lifting in terms of really spending money on building infrastructure and capex. Economists have been arguing over the last 1 or 2 years whether the private capex or private spending has come commensurate to what the government is doing. Also, whether a consumption-led growth is eluding us. So possibly these are the two factors where the government believe that it is high time now that after all the heavy lifting that the government has done, that the private consumers as also the private sector should start spending more in terms of ensuring the growth uh, coming back to the economy. A small point that this benefit of nil tax up to 12 lakh rupees accrues only if your income is 12 lakhs or lower. Moment your income crosses the 12 lakh threshold, then your tax liability as per the new slabs will be applicable. To ensure that when you cross the 12 lakh limit, your incremental tax liability is not higher than the incremental income. Assuming your income was 12 lakhs, and if now it has become 12 lakh 10,000, then your income has actually increased by 10,000. But your tax liability should not increase more than the 10,000 income, and therefore there is what we call technically a marginal relief which is applicable. Vishal, next slide. So if you see, this is how the whole benefit actually plays out. I'll spend, a few seconds and let people draw their conclusion. But if you see the benefit goes up from, 7 lakhs currently, there is nil tax. From 8 lakhs to 12 lakhs, the benefit to the taxpayer increases. Once the 12 lakh limit is breached, then there is a reduction in the benefit that accrues to the taxpayer. But because the slab rates have all been expanded, uh, you start accumulating, more tax benefit. And if you see the column on the right hand side, up to 12 lakhs, whatever was your tax, 100% of that tax comes back to you by in the form of a refund. So somebody who is earning income in the bracket of 24 lakhs to 50 lakhs, 27% of the tax savings is available to you, which reduces to 9%. And therefore, if you average it out, a 15-20% reduction for people who are in the 25 to 50 lakh tax bracket. Across the slabs, there is at least a minimum of 1 lakh plus benefit available to taxpayers. And therefore, this is how the money has been put back in the hands of taxpayers. And one only expects that the middle class, the ball is clearly in their court to ensure that whatever is the confidence that the government has placed on them gets amply rewarded by higher and better compliances. And with this confidence, we hope the major bold reform that has been initiated by the government continues over the next 5-10 years. With this comments, I'll ask Vishal to take the discussion forward.
Thank you, Umesh. Good afternoon, everyone. And on the note that the theme of the budget this year has been around simplification, rationalization, reducing compliances. The next topic, which would be of relevance and could impact a lot of taxpayers, is in relation to TDS, the taxes which are withheld on any payments which are made to taxpayers on different types of income. One such income is securitization trust. Securitization trust typically does a withholding tax of 25% or 30%, depending on whether they're making a payment to an individual or an HUF on any income that they are distributing. Now, that has always been an issue because there's a cash trapping which happens. There is a delay in release of the funds because the investors have to file their return and then claim the refund. They have now sought to reduce the withholding tax rate to 10%, which is a welcome change. This was absolutely necessary, especially in a situation where these same securitization trust, when they are making payments to non-residents, withholding tax on such payments are eligible for lower rates. In most cases, it'll range either between 10 to 15%. I think this was absolutely necessary, and that's what they've tried to do. There is changes around TCS on liberalized remittance scheme. So any resident, when it's repatriating any funds outside of our country, they are eligible to do so under the liberalized remittance scheme of 250,000 US dollars. Now, a couple of years back, the government introduced a provision where they sought to collect taxes at source on any remittances which is leaving the country. And the rates were in the range of 20% to 0.5%, 20% being the general category. There was a 0.5% TCS which was applicable on remittance from loan, which is taken for educational purposes from certain financial institutions which are generally servicing or providing such education loans. This was an issue because a lot of students themselves were taking loans and they may not have taxable income. And whenever there's a TCS which is being collected by the bank at the time of remittance, that was allowed as a credit to these students or these remitters. But then that credit you would have to file a return of income and then claim that credit back, and it would come back to you as a refund. They have now rationalized this and they have said that there will not be any TCS anymore. This should give some boost to the loans which are being extended for the education sector specifically. Also, the TCS on these LRS remittances were only triggered if the amount of remittances in the entire year, in a financial year, was in excess of 7 lakhs. That has now been increased to 10 lakhs, so there is some relief there. This is much welcome. There is a TCS which they introduced a few years back. This is a recent provision, I must say, on sale of goods. And the reason why this is relevant is goods also include securities. So the government did clarify that listed securities will be out of this ambit and there will be no requirement to do TCS on listed securities. But unlisted securities still continue to be under this ambit. So for example, in a lot of cases in the last 1.5 years, we have seen NSE shares, Swiggy shares, all of these being unlisted, which have been exchanging hands, and the seller is subject to TCS. Now they have completely removed these provisions, and these provisions will no longer be applicable on any type of goods, including unlisted securities. TDS, the TDS TCS provisions were applicable when a person was making payment to any person. And in case that person, the recipient, had not filed his return of income, the TDS rates could be higher. It could go as high as 20%. Now those provisions have now been removed. This was an administrative issue for the payer of the income, as he was responsible for checking whether the recipient had filed its return of income in this preceding years. The government had introduced certain uh, uh, platforms where the payers could check whether the recipient is a defaulter when it comes to return of income. But this was unnecessarily creating a lot of administrative hassles for the payers who are responsible for doing TDS, and they have now removed this provision. Another change is on TDS, the withholding tax on rental. So TDS is applicable on rental payments wherever the threshold of the rent is in excess of 2.4 lakhs. They have now extended this limit, increased the limits, and TDS will not be applicable so far as the rental amount remains below 6 lakhs. So now the 2.4 lakhs threshold has been increased to 6 lakhs. Apart from this, there are other thresholds which have been increased, up to which there is no TDS which is applicable. Some of them we've tried to summarize it here. As you can see, interest on securities, there was no threshold, and now there will be a threshold of 10,000, which means up to 10,000 if there is any interest which is received on any securities. There will not be any withholding tax. Dividend, this is quite common, up to 5,000. Everybody used to receive dividend from companies after withholding tax the moment the dividend was in excess of 5,000. That threshold has now been increased to 10,000, which is doubled. In lot of cases, they have doubled it or significantly increased the thresholds. One notable threshold is those applicable to interest, which is being received by senior citizens. From 50,000, it now stands increased to 1 lakh. This is a welcome change. Also, similarly, there are changes on other TDS where the thresholds have been increased from 5,000 to 10,000 in case of interest on other than securities payable by other payers. Lottery tickets, brokerage, everywhere there is a marginal increase in the thresholds. On the rental, we did discuss there will not be any TDS on rental where the amount is not exceeding 6 lakhs. That's something that we've already discussed. On professional and technical services, fee payments, the threshold is now extended to 50,000. Income in respect of units has been doubled from 5 to 10. Enhanced compensation has been doubled. The TCS on LRS we've already discussed on the previous slide, where the 7 lakh limit has been increased to 10 lakhs. There is no change in business profit taxation except for two changes. One is in relation to startups. There is a tax holiday which was provided to startups provided they were set up to 31st March 2025. That setup date has now been extended to 2030. This goes well with the entire theme of the government to promote startups. There are a lot of regulatory changes which are coming around, and similarly, a notable change has been made under tax, so such that the tax startups can continue to flourish and enjoy the tax holidays. There is an entirely new provision which has been introduced, which should benefit the electronic manufacturing facilities in our country. This is in line with the theme of giving a lot of subsidies, a lot of rationalization, simplification for EV manufacturing, EV vehicles. So any non-residents, the presumption is that any non-residents who are providing services for such electronic manufacturing facilities, they will not be subject to presumptive taxation, which means only 25% of their receipts will be treated as business income and be subjected to tax, subject to some other conditions which are applicable to them. So this is an entirely new provision which can be kept in mind. Some changes around GIFT City, IFSC. The entire theme of the changes is twofold. So a lot of exemptions were available on various types of income received from the IFSC units or in the hands of the IFSC unit, where the unit was commencing its operations up to 31st March 2025. So the common change is the 2025 date has been shifted to 2030, and you can, so far as you're commencing your operations till 2030, you will continue to enjoy all those exemptions. The second theme of the changes around IFSC is to include ship leasing along with aircraft leasing. Aircraft leasing in a lot of cases, either the investors in the aircraft leasing or the aircraft leasing itself was enjoying certain exemptions, deductions, tax holiday. They have now been also extended in the same breath to ship leasing as well. So these are the broad changes. Now going into the specific changes, for example, investment division of an offshore banking unit, which is in IFSC. It was enjoying an exemption on all the income that it was earning so far as it had commenced its operations on or before 31st March 25. Now, so long as it's happening till 31st March 2030, they will continue to enjoy those exemptions. The royalty interest on lease, which is earned by non-residents when they're leasing aircraft or ships to IFSC units, exemption was available to them so far as the units are commencing their operations. Now, the date has been extended from 25 to 2030, even in those cases for commencement of operations. Tax holiday was available on gains on transfer of aircraft, shipping by IFSC units so far as units commenced operations prior to March 25. That stands extended to 30. There is Also, an interesting change, and this is in line with the regulatory framework that they have been introducing. So, to give a background, a lot of FPIs enter into offshore derivative instruments or participatory notes with their foreign investors, which allows these foreign investors to get indirect access to our Indian markets and enjoy the commercial benefits, commercial returns. So these FPIs are directly accessing the Indian markets, taking the relevant registration, licenses, investing in India, making the necessary gains. And a part of those gains, or in certain cases, most of the gains are passed on to their investors who are holding the P notes or offshore derivative instruments. So the government had introduced a provision in IFSC for IFSC units where any non-residents who enter into contracts with offshore banking units in IFSC and they were earning any income from those contracts, offshore derivative instrument related contracts with offshore banking units, all the income was not taxable. They have now extended to include even FPIs. So along with OBUs, even FPIs have been added to that list. So any non-resident entering into these ODI instrument contracts with these FPIs will continue to enjoy exemption on those gains on those transactions. Exemptions to non-residents IFSC units on capital gains, on transfer or gains of IFSC on transfer of IFSC company shares who are engaged in aircraft were available. So far as the IFSC company, which is engaged in aircraft leasing, commenced its operations on or before 31st March 2026. Two changes, as I mentioned earlier, ship leasing has been included in this list, along with aircraft leasing. Even ship leasing units in IFSC are permitted. And the sunset clause for commencement of operation stands extended to 31st March 2030. A few more changes on IFSC. The dividend which is received by any unit from another IFSC company which is engaged in aircraft leasing, the same was not taxable. Now, apart from aircraft leasing, even if you have IFSC company engaged in ship leasing, they too are now included. For relocation of funds, the entire intention of the government for IFSC has been to encourage foreign participants to come and set up their base in IFSC. And also to encourage all ancillary units to also support those financial units. One of the focuses has been around attracting foreign funds, and they have created an entire tax framework which provides tax neutrality when the foreign funds move to IFSC. Now, this provision has always been there, and any movement of offshore funds into IFSC provides complete tax break, not only to the offshore fund, but also to the investors of the offshore fund, which typically would have suffered tax. Now, these offshore funds, when they move to IFSC, need to register as an AIF. They also have an option of now registering themselves as retail schemes or ETFs and can continue to enjoy the same tax neutrality which are available on this relocation. Also, the relocation date, there was a cutoff that they wanted all the relocation to happen prior to 31st March 2025. The date has now been reset to 31st March 2030. So the relocation of funds can happen till 2030. Also, they have provided some impetus to finance companies who are being set up in IFSC as global treasury centers to encourage that whenever there is a global treasury centers, they have presumed that the business necessitates that there will be loan transactions. There will be an extension of advance to those units to ensure that the treasury operation is undertaken. Typically, in our domestic tax law, any loan or advance that you give to the other related party, so-called related party, it is characterized as dividend and suffers the dividend taxation. This was creating a roadblock for global treasury centers to flourish in IFSC. They have removed that roadblock and now clarified, or I would say, rationalized it by saying that even if any loan or advance transactions are undertaken between the parent company and the IFSC unit, which is going to be set up as a global treasury center, will not suffer the deemed dividend taxation. On the life insurance policy, ULIPs, any premium which is paid in excess of 2 lakh 50, in such cases, there was always a provision which mentioned that any maturity proceeds in case of premium being in excess of 2,50,000 will be taxed and will not enjoy the exemption. Now, there is some relaxation for policies being taken from an IFSC insurance intermediary entity. So, for policies taken from IFSC units, even where the premium is being paid, which is in excess of 2,50,000, or for ULIPs or 5 lakh for other policies, the exemption will continue to be available. This is a welcome change. Everything to which will further add to the flourishment of IFSC.
So Vishal, if I can just come in for a minute or so, I think IFSC units which are set up, they enjoy complete tax exemption. And if we see over the last few years, every year the government is trying to make the IFSC regime more attractive, both for non-residents as also in some cases for residents to use IFSC as a vehicle for multiple activities. And I think this augurs well. The sunset date, which has been extended for a clear period of 5 years, ensures that people get enough time to plan and to create their entry in the IFSC. So a lot of positive changes which will encourage build the entire traction on the IFSC side.
Thank you, Mitch. Some more changes, a few of them quite relevant from the perspective of AIFs and the investors in the AIF. So there is a change specifically for a couple of categories of AIFs, category 1 and category 2, which enjoys pass-through status. However, there is no specific law which prescribes the nature of the asset held by the AIF, whether it will be a business asset or a capital asset. This is important because depending on whether we call it as a capital asset or a business asset, the gains will either be capital gains or business income. In this finance budget, they have clarified that all securities held by category 1 and 2 AIFs will be considered as capital assets, which means any gains earned by them will be capital gains in nature. And since they are passed through in nature, the investors will enjoy the capital gains tax rate, which is a lower tax rate. This was important. Having looked at AIFs very closely, category 2 AIFs specifically, which is quite common, who are doing debt instruments, there's a lot of churning which actually is undertaken by these type of category 2 AIFs, because of which there'll be a lot of frequency in transactions, there'll be a lot of volume, and there is always a risk of these category 2 AIFs being subject to business tax, which is the higher tax rate. This now settles this ambiguity, and going forward, irrespective of the nature of frequency, volume, all assets invested by category 2 AIF and 1 will be treated as capital gains. For sovereign wealth funds and pension funds, there has been an exemption provided, specifically in case of long-term capital gains and other income. And the exemption was subject to certain conditions. One condition being that the investment should have been made on or before 31st March 2025. They have extended that date. So we could expect some inflows, some foreign inflows, which should benefit our economy, because they can continue to invest up to 31st March 2030 and enjoy these benefits and these exemptions. Another, I would say this is more of clarificatory in nature. There was a change made a couple of years back, and again in July 24, there was another change with respect to debt instrument, unlisted debt, mutual funds, market-linked debentures. All of these investments would now have been subject to short-term capital gains rate. And sovereign wealth funds and pension funds have been specifically given exemptions on long-term capital gains. So the issue was that after the changes which have been made in the last couple of years, where they have treated all kind of debt instruments being subject to short-term capital gains, by virtue of these provisions, sovereign wealth funds would not have enjoyed exemption when they invested in unlisted debt. They have now clarified that all the debt instrument that they will invest in will not be subject to those provisions, and they continue to be long-term so far as the period of holding it is met, and the exemption will be available to them. For FPIs, In fact, 12.5% is a rate now everybody is aware of. There are couple of situations which probably they may have missed that could not get covered in the earlier budgets, and they continue to be subject to 10%. They have now also been ironed out. They also have been brought to the rate of 12.5%. One such situation was for FPIs where they were investing in listed debt. It appears that they had missed out in the last budget where the rate continued to be at 10% when FPIs made gains on listed debt. Now that has also been corrected to 12.5%. For business trust, when they are investing in listed equity shares, security instruments on which a security transaction tax has been paid, like mutual funds or another business trust which are listed, they have clarified that they will continue to enjoy the 12.5% tax rate. Another change is on updated return. On the updated return, this is actually a facility provided to the taxpayers, whereby if they have missed reporting certain income, which has skipped their attention or for whatever reason, they are giving an opportunity to such taxpayers to update the return and disclose that income. Of course, there is a minor penalty or there is an additional tax, I may say, that they have to pay when they are exercising this option of updation of return. That was possible for 2 years from the year in which they filed the return of income. They have added another 2 years. So you have 4 years window now. This is clearly an area which they see that the taxpayers are showing a lot of interest. Of course, there were some rates for penal interest that you have to pay if you're updating your return within 2 years. Now that 2 years has become 4 years, they've added 2 more. So if you do it within beyond 24 months and up to 36 months, then what is the rate? And then beyond 36 months, what will be the rate? Similarly, some reassessment proceedings related period has been rejigged when it comes to updation of returns.
So Vishal, on the updation of return, clearly it's this is in line with the trust-based approach of the government where they want the taxpayers to voluntarily comply, and just as a little bit of carrot and stick, rather than foisting taxpayers with heavy penalty and reassessments. I think the window of updating returns is a welcome thing. Added to this is also the fact that today the entire lifestyle of the taxpayers is being profiled by the government, and they, from whatever we hear, they have a artificial intelligence based tracking mechanism which looks at all the social media and all the credit card activity and multiple other activity, and therefore if your income is not in line with the lifestyle that you are living, in the last 2 3 years a lot of taxpayers have been sent notices, and most of the updated returns that we see is because of this sort of notices that are coming. So again, government is trying to push people to change their old habits and come with better compliance before really getting hit by penalties and stiffer provisions of law.
Thank you, Umesh. Some few more changes. One is around the transfer pricing assessments, similar to the regular assessments that the assessees go through. Transfer pricing is relevant when they are related party transaction. We thought of mentioning this here because this is an interesting provision. This is not something that we have seen, and they have tried to introduce it specifically for transfer pricing matters, where they are now introducing an option where you can club 3 years and do an assessment for that 3-year block altogether. There are certain conditions. I think this is a provision which will evolve as we proceed. We'll have to see how it is actually implemented in reality. Also, on the taxability of ULIP, we just spoke earlier about how ULIPs, any maturity from ULIPs continue to be exempt so far as you are meeting a particular threshold. There was always a lack of clarity on what happens if it's a taxable ULIP. How do you tax it? Is it something which is taxed at the highest rate, or will it be subject to capital gains benefit? They have made it very absolutely clear now that this will be treated as capital gains. So any taxable ULIPs, by virtue of the excess premium that you pay all maturity becomes taxable. In such situations, we clearly have to just see whether you just have to treat it as capital gains and tax it at the rate of 12.5%, assuming it is long-term in nature. For crypto assets, they're very clear that they want to ensure a level of reporting to be made to the government wherever there are any crypto assets involved. So they have prescribed certain mechanism on crypto assets as well, which we will see as and when it is implemented. On that note, we are happy to take any questions that the audience may have. Gaurav.
Yeah, thanks, Vishal and Umesh. Thank you so much. It was really insightful of you to present all these nuances to us and our clients. You know, I think as a reminder, people can ask questions by typing in the Q&A window. So there are a couple of questions. I'll probably first start with a couple of questions from my side. One, the finance minister also informed everybody that within the next 7 days there'll be a revised new avatar of direct tax code that she will unveil. So any thoughts from your side in terms of what we can expect on those lines, and what will it entail over and above what got discussed in the tax proposals?
Yeah, so 2 points. I think government clearly has identified that our tax laws need to be in line with the expectations and aspirations of the nation, and therefore there is an expectation that the new tax bill will be simplified. So already the FM has said that the number of chapters and the number of words will be 50%. Also, I think all the 3-4 dimensions that the government is saying, more trust-based tax regime, administration which is responsive to the taxpayers, compliance burdens being brought down, more tax certainty being introduced, and litigation either being reduced or at least faster resolution of litigation, so possibility of dispute resolution mechanisms. These are the 4-5 points on which various industry associations, professional advisors are having discussions with the government. One only hopes that some of the points on which discussions are being initiated with the government really find a mention in the tax bill. Another point is that typically whenever we as a advisor experience over the last almost 40 years is that whenever the government tries to simplify the law, they end up complicating it. And because then you lose with a new law, you lose the entire jurisprudence that we've had so far. So I think we are trying to exhort the government to ensure that when the new law is brought into picture, it matches with the expectations, and the quality of drafting is as best as possible. So positive hopes, but we'll have to see the reality over the next 6-8 months.
Yeah, let's hope for the best. Okay, so some questions have started to pour in. An anonymous attendee has asked, "Hello, sir and team. Assuming my income is 12.75 lakhs, can I take 75,000 as standard deduction?"
Yeah,
And the
I think
answer is yes.
this is
Yeah.
clearly possible that your taxable income. So after the standard deduction, your taxable income needs to be 12 lakhs or lower, and there are a few deductions. So while most of the exemption deductions are not available in the new regime, but NPS, for example, is one deduction which is still available in the new regime, and therefore, if you have NPS contributions, then on a gross basis, your income could be 12.75 plus permissible NPS deduction.
I think, yeah, on that, on that note, there was one more question that I wanted to uh, get your views on, and for the benefit of our listeners and clients. There is also now, post the budget announcement and the way they have made the new regime so attractive, there is chatter about the old regime getting sunset, sooner. Uh, and if that happens, of course, all the deductions which are available for promoting investments into mutual funds, into insurance or various other avenues, uh, they may get an impact. So from your experience, given that, financial deepening is still happening, do you believe there'll be, meaningful impact on, asset management companies or insurance companies, or it is just, a small, roadblock, and the growth itself will take care of these issues?
So again, I think the government, clearly the messaging from the government is that, rather than having, deductions and exemptions, pushing people to invest, they want, money to be left with the taxpayers, let them take a call on the basis of, where they find the returns more attractive. So the arbitrage based on tax deductions, I think over the years you will see that, that will continue to reduce. Let people take a call whether they want to invest basis the returns that they are getting, or they want to enjoy a better lifestyle. So if people spend money, is also good for the economy. If people invest, also is good for the economy. And of course, what you say for mutual funds and asset management companies, obviously you want more money coming in. But if you see over the last, I think 2 years, the amount of money that SIPs and mutual funds are generating, despite a lot of FII selling, I think, the Indian domestic investors have pitched in. And I think this is clearly the messaging from the government that let people invest back basis their own calculations and expectations.
Got it. Uh, Next question is a very specific question. Land sold between 1st April 24 and 23rd July 2024. Why no option is given to avail 12.5% LTCG tax, and why only indexation benefit when if sold after 23 July 24 option is given to avail either indexation or 12.5%?
Yeah, so I think, the new regime where they rationalized the tax rates for long-term capital gains and brought it down from existing 20% to 12.5, kicked in from July 23. After this was introduced, there was a hue and cry in terms of people losing out the indexation benefit. So they restored the indexation benefit for people who had properties purchased earlier than 23rd July. But because the new concessional regime kicked in from July 23, the benefit of the new regime was not extended to people who have sold uh, properties before July 23. So the other option is available, but not the other way around. People who are selling post July, they have best of both world. You calculate your tax liability basis indexation or basis the lower rate, and then take a call whichever is lower and accordingly exercise the option.
Got it. Next one, Sanjay Kumar is asking, will these changes be applicable from March 2025 onwards, or from which date? So I'm assuming these are, from next financial year is what typically the budget proposals are applicable
Yeah,
for.
yeah. Clearly, I think it will be for salary, which is earned from the next financial salary, or incomes earned in the next financial year.
All right. Joseph KJ is asking, if the salary income is rupees 10 lakhs and STCG is rupees 1 lakhs and LTCG is 0.75 lakhs, so total of 11.75 lakhs, what will be the income tax?
Yeah, so I think a simple answer is that the rebate that you get for income up to 12 lakh is not available for any capital gains which are subjected to concessional rate of tax. And therefore, long-term capital gains which are subjected to concessional rate of tax, they are out of the calculation for the rebate. But if you have short-term capital gains which are part of your normal income, I would believe that you will get a concession on the rebate. On the long-term capital gains, you will have to pay the tax basis whatever is the total gains and the applicable tax rate.
Got it. So in this example, 10 lakhs of salary plus 1 lakh of short-term capital gain will be clubbed, and there, the slab benefit can be taken. 75,000 worth of long-term capital gain will be separately taxed.
Correct. 11 lakhs, no tax on the 11 lakhs, and on the 75,000, whatever is the tax has to be paid. In the past, there were the CPC was creating some errors in terms of giving the relief. the budget provisions they have clarified, and therefore now it appears to be clear that all long-term capital gains subject to concessional rate will not be eligible for this rebate in under Section 87A.
Okay. Okay, there's a very specific question on a company by Rani Mishra. I don't think so. We'll put that out, but generally, on FMCG companies, is there any benefit from a taxation perspective?
As we've seen, no major changes in the corporate tax rate. So I think as far as the tax proposals are concerned, they are pretty neutral. But I think what could be the expectation is that because 1 lakh crore worth of tax is foregone, that much of money is available to taxpayers, and therefore if people start spending, which is the expectation of the government, then a part of what has been given on the direct tax side could get recovered by better demand and all the the multiplier effect of higher demand, including GST. And if you see the overall numbers that they have put in, I think they are still expecting almost a 14% increase in the tax collections, which is little higher than the nominal GDP growth, and therefore the government is confident. I think a lot of confidence and a lot of bold calculations have gone into giving such a bounty relief. What we are seeing in the last 40 years, clearly I haven't seen any slab rate rejig which are so significant.
Got it. Next question is, wasn't 6 lakh rental income limit for TDS not applicable in 24-25 from July or August 2024?
So the residential has always been 6 lakhs. So land or building other than residential now, which was earlier 2 lakh 40, has become 6 lakhs.
Okay.
And plant and machinery or anything like that.
Okay. Mahak Kansal is asking on AIS, what is the tax rate for NRI if we invest from Dubai? Can individuals send money or a corporate entity? Will this be linked with USD rate or rupee at the time of redemption?
No, so again, there are a lot of subjectivities here in the question, but let me assume a few fact patterns and answer this question. Assuming the individual is invested in a category 1 or 2 or a category 2 AIF. As I mentioned earlier, they have now said that any securities held by the category 2 AIF will be treated as capital asset. So let's say the category 2 AIF is selling some debt instruments, or they are selling some shares which are unlisted in nature. They all will be capital gains. And now the NRI who is in UAE will be subject to tax as per the relevant rates applicable to the capital gain. And there is also a tax treaty between India and UAE. Assuming he is eligible for those benefits, if it is listed shares, unlisted shares, he will pay 12.5% tax. There is no benefit under the treaty. But if it is debt, then there is absolutely zero tax. There is no tax on capital gains on debt, and this is what he will enjoy. So everything becomes capital gains. The same will be the treatment in the hands of the NRI, subject to the tax treaty benefits.
Got it. Okay. Next one is, not okay. Maybe a point related to the earlier question that we had answered, where we had said that STCG, can be added to the salary part for claiming, the slab benefits. But I think somebody is highlighting STCG is also 20% concession. So how we can club that?
Yeah, so I think it's a important question to clarify. I think what I've mentioned is that wherever there is a concessional rate of tax, then that concessional rate of tax will not go into the calculation for this 12 lakhs limit and the rebate. So as far as STCG is concerned, listed securities, you have a concessional 20% tax, but there's a normal tax for all other non-listed STCG gains. And therefore you'll have to decide if it is concessional rate, then you don't get a rebate. But if it is not concessional rate and it is part of your normal income, then the rebate up to 12 lakhs would be available.
Got it. Hope that clarifies to the anonymous attendee. Thank you so much for highlighting. Old regime is good for which salary bracket? For example, old regime is good for salary above 15 lakh or 20 lakh or 30 lakh.
There are Gaurav, lot of tax calculators that are
Yes.
available now, but I think clearly as we see the arbitrage is clearly shifting away from the old regime, because as the difference increases, it becomes very difficult that if you even include all the deductions, exemptions, and when you see the difference between old and new regime, HRA is one major thing.
Yes.
Of course, your ATC, all your life insurance and other things also. But all of them will need to add to a sizable amount. If your salary rates, I mean, the overall salary is lower. So as people move into higher tax brackets, where again, if there are donations and things like that, then you'll have to look at all the concessions or exemptions that you are getting, and then do the calculations. Seems very difficult. Now, most people would prefer the new regime is what the expectation of the government is. And barring a few, situations, by and large, most people might prefer to be in the new regime. But everyone will have to do their calculations and go back to their tax advisor, or see, where the arbitrage settles finally.
Uh, Next question is from Arvind R. He's asking if the income is only rental or only business, is there no tax till 12 lakhs?
Yeah, clearly. I think, on in the 12 lakh, whether it is salary, business, rental, all incomes put together. If you have rental income from house property which is owned, then you get a 30% standard deduction. After that 30% standard deduction, you have to look at your taxable income. And moment the taxable income is 12 lakhs or below, then you get the benefit of nil tax.
So only capital gains is something that they have excluded from the rebate, which are subject to special rates. Everything else will enjoy the rebate.
Good. Mahak Kansal is asking a question on what is AIF1 and AIF2. So, Mahak, just to answer, that is not related to taxation, but SEBI has alternative investment fund regulations under which there are three types of alternative investment funds that can register. 1, 2, and 3. One is clearly funds that have strategies which are pro-growth, promoted by government. There are concessions, infrastructure oriented, all that stuff. AIF3 refers to complex strategies where there could be listed, unlisted derivatives, leveraging, long-short strategies, and different types of strategies pulled in. And anything that cannot get classified in 1 or 3 is actually AIF2. That is a basic understanding. Please get in touch with your relationship manager for a detailed understanding of that. I think last question on the list is any changes for family trusts?
Again, no changes, but I think there is a little bit of gray area in terms of how family trust would, whether they get the benefit of the new regime, and possibly if the questioner has this in mind. I think there is no clear, simple answer. I think it will have to be separately handled offline, because family trust, depending upon what is the structure of the family trust, could be treated as individuals and therefore entitled to the benefit of this concession. But I think no simple answer here.
Got it. So I think we are mostly
We can take
at
one
the
more question. I think we can take one more question, which is come on 12 lakhs. If there is 12 lakhs of rental income and another 15 lakhs of capital gains, will my 12 lakhs be exempted and I only pay tax on 15 lakhs of capital gains? The answer to that is yes, you will pay only 12.5% tax on the long-term capital gains. Over to
Got
you.
it.
Yeah.
One last thing, Vishal. So there was also a extension of the date of registration for startup companies. Could
Yeah.
you throw some light on that? Because that's a very vibrant part of our economy. So unless I missed out that we covered that,
Yeah,
that
we did cover it. So there is a startup definition. If you are DPIIT registered startup, then you are eligible to enjoy a tax holiday, and the tax holiday was available to you if you were incorporated or set up uh, before 1st April 2025. They have extended that to 2030 now, so which is a welcome thing because we are nearing end of this clause. So this will encourage more startups to take registration with DPIIT and enjoy the tax holiday which is available. And with respect to the tax holiday, there was a 3-year consecutive years that they could claim the tax holiday out of the 10-year window from the date of incorporation. So that extension is now there. So all startups which are incorporated till 2025, now even those incorporated till 2030 will enjoy this.
Gaurav, wherever they have come out with date extension, I think this is a very clear proposal where the date extensions have been given for an entire block of 5 years, which is very welcome so that people can plan and there is certainty available rather than looking for a year-to-year extension or a nominal extension. So
yeah. Yeah, that clearly shows the intent of the government to continue with the benign policies, encouraging the startup ecosystem, simplifying, the regime and laws, trusting people, and believing them, hoping for self-compliance and, better compliance from everybody. So I think it's been a great last 1 hour 10 minutes spent, Umesh and Vishal. Thank you so much for joining us today on this webinar and explaining all the nuances to our clients. We appreciate your time and effort in sharing your expertise with us, and look forward to your continued, participation in times to come on whatever events happen in the market, which are important from a taxation perspective. Of course, as we briefly discussed, about a week later, there'll be another, big document to analyze and look at. So you'll have a busy February going forward, and we will soon circle back with you to understand your perspective on what changes after, the new direct tax code gets released. With that, we will conclude this call. Ladies and gentlemen, thank you so much for being patient listeners. We really hope that all the insights that you've gained will benefit you in some shape and form in your investing or business or personal financial taxation planning. With that, we conclude the call. Thank you so
thank you.
much.
Thank you for this
Thank you,
opportunity.
IIFL and Gaurav. Thank you, participants.
Thank you so much. Yeah. क्या करने हैं भाई?